2.4 trillion. That isn't a deficit. It isn't the GDP of a G7 nation. It is the amount of cash that major financial institutions parked overnight at the Federal Reserve S-reverse repo facility in a single 24-hour window. Think of it as the world's most expensive mattress. The banks were so terrified of the open market, so paralyzed by the risk of lending to you, to businesses, or even to each other, that they chose to earn a pittance of a yield just to keep their capital in a cryostatic freeze. While the news focused on the price of eggs and the political theater of the debt ceiling, the real money was doing something far more terrifying. It was standing still. We are taught that money is a store of value, and that is a lie. In the modern financial architecture, money is not a battery, it is a current. It is kinetic, it is a shark that dies the moment it stops swimming. The global economy is built on a premise of infinite velocity. The dollar must move from a treasury bond to a repo desk, to a hedge fund leverage account, to a corporate payroll, and back again. But right now the viscosity of the global financial system is thickening. The gears are grinding against grit. We are witnessing the precursor to a phenomenon that tears civilizations apart not by explosion, but by suffocation. To understand why the stillness is lethal, you have to stop thinking about money as cash in your wallet and start thinking about it as collateral in a chain. In the shadow banking system, the dark, unregulated underbelly of finance where the actual heavy lifting happens, a single US Treasury bond is not owned by one person. Through a process called rehypothecation, that single bond is lent out, used as collateral for a loan, then that lender takes the bond and uses it as collateral for their loan, and so on. $1 of pristine collateral might support $5, $10, or $20 of leverage in the system. This creates a multiplier effect of wealth. It looks like growth. It feels like prosperity. But it is entirely dependent on the speed of the transfer, the trust that the next link in the chain will hold. When velocity drops, when that $2.4 trillion decides to sleep at the Fed instead of entering the arena, the leverage unwinds, the chain goes slack, and when the chain goes slack, the multiplier works in reverse. Liquidity evaporates. This is the mechanism of the liquidity trap. The central banks can print all the reserves they want. They can helicopter drop cash onto the population, but they cannot force the money to move. They cannot force a bank to lend when the bank knows the collateral is phantom. To understand where this ends, we have to look at 1931, specifically the collapse of Credit-Anstalt in Austria. The Great Depression didn't see to start with the stock market crash of 1929. That was just a repricing of assets. The Depression, the decade of misery, began when the velocity of money collapsed in Europe. Credit-Anstalt was a solvent bank technically, but the trust evaporated. The interbank lending market, the plumbing of Europe, seized up. Money stopped moving across borders, then it stopped moving across cities, then it stopped moving out of pockets. The velocity of money hit zero. And when money stops moving, prices don't just fall. The mechanism of exchange disintegrates. We reverted to barter. We reverted to starvation amidst plenty. Farmers poured milk into the dirt because the financial vehicle required to transport it to the city had run out of gas, not petrol, but credit. Fast forward to September 17th, 2019. The Repo Crisis. Overnight lending rates spiked to 10%. The plumbing clogged. The hardware of the global financial system jammed. The Federal Reserve panic-printed billions, not to stimulate the economy, but to grease the gears of the repo market because the banks stopped trusting each other. S-collateral. They saw the ghost of 1931. They saw the stillness coming. Now look at the yield curve. Look at the inversion. Short-term debt pays more than long-term debt. This is the market screaming that the future is broken. Investors are demanding to be paid more to hold money for 3 months than for 10 years. Why? Because they don't believe the current system survives the next 24 months without a reset. The forward scenario is not hyperinflation initially. It is a deflationary shock of terrifying proportions, followed by a monetary response that changes the nature of money itself. As the velocity of money creates a deflationary death spiral, the central banks will realize their old tools, interest rate cuts and quantitative easing, are pushing on a string. You cannot make a dead horse drink water. So they will change the water. Enter Central Bank Digital Currencies, or CBDCs. This is the only technological solution to a velocity crisis. Programmable money. Money that expires if you do not spend it. Imagine a stimulus check that dissolves in 30 days. Imagine a savings account with a negative interest rate that automatically deducts 2% of your wealth every month to encourage investment. This solves the velocity problem. It forces the money to move. It forces the shark to swim. But it kills the concept of savings. It kills the concept of private property. It turns money from a store of value into a government-issued voucher for existence. In the next 12 to 24 months, watch the reverse repo numbers. Watch the collateral shortages in the euro-dollar market. We are approaching a sovereign debt wall, trillions of dollars of government debt that needs to be refinanced at interest rates the system cannot afford. When that wall hits, the liquidity will dry up instantly. The bid-ask spread on assets you think are safe, municipal bonds, real estate, ETFs, will widen until it creates a vacuum. You will try to sell and there will be no buyers. Not because the asset is worthless, but because the medium of exchange has frozen. The system is currently oscillating between fire and ice. The inflation was the fire. The response is the ice. The central planners are trying to engineer a soft landing. But you cannot land a plane when the air itself has turned into a solid block. The controlled anxiety you feel when you look at your portfolio isn't paranoia. It is your instinct recognizing that the kinetic energy of the economy is bleeding out. The distraction is the stock market index. The reality is the plumbing. We are moving toward a moment where the choice will be between a total systemic default or the implementation of a monetary system where privacy is the price of liquidity. History doesn't repeat, but it rhymes. Subscribe to see the pattern.